Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hello again. It's Friday. Welcome to the daily version of Talking Real Money. I am Don McDonald. Another short version for you with a couple of things for you to cogitate on, maybe to learn from. And if you have a question that needs answering, give me a call at 855-935-TALK, 855-935-8255, 24 hours a day, 7 days a week, or tomorrow, Saturday, Tom and I will be back together doing a 2-hour live call-in on Como Radio in Seattle. You can call us live from 3 p.m. to 5 p.m. Eastern or noon to 2 Pacific time at that same number. Works everywhere. 855-935-TALK. You can also send your questions in at our website, talkingrealmoney.com, where in addition to asking questions, you can also set up an appointment to talk with one of our advisors for free for a little while if your question is a little more involved or a little more personal or very specific to you and you don't want to do it here. It is free. There is no obligation. And no salesperson will call. We don't sell stuff. Oh, if you want to be a client, cool, that'd be great, but we don't pressure you into doing that. 855-935-8255 is our phone number. Give me a call. I'd love to try and help you deal with money better in ways that are actually a little more complicated than most of the money advice you hear on the radio. And I'm referring, yes, in Money Magazine. Dave's in the latest issue again. He was in Money in like 2013, and he's back in Money here in April of 2019. You know that Dave Ramsey has like the third largest radio audience in the country? Third largest. And it's all about debt. But you know, it really is about more than debt. The debt message is important. Debt is bad. Get rid of debt. That's his message. But it's how he does it. It really is. I've always believed. As a matter of fact, I think I got my best ratings over the years when I ranted more with more of an evangelical flair. And that's what attracts people to Dave, is that it's the passion, it's the emotion of the message. Now, in reading through the article, I saw a little glimmer of hope. It was so great. It was wonderful because I've always said, yeah, you know, Dave's good if he gets you out of debt. Awesome. But Dave's making a lot of money. Dave is worth, I don't know, I think they said in the article about $55 million, which I guess it's not, like Microsoft founder money or anything like that, but it's pretty comfortable. But no, in the article, they talked about the 2013 article where the authors of that slammed him for his investing advice, for which I have slammed him regularly. There is no way to go out and get 12% with low risk, basically what he tells you to do. And then he tells you to go buy funds, or he told you, apparently, I don't know, to go buy mutual funds from stockbrokers who charge commissions because they have the heart of a teacher. No, they don't. They have the heart of a salesperson, which isn't a terrible thing, but don't make them out to be something special because they pay you money. But the good news, way down in the article, they talk about his terrible financial advice in the past, and I haven't listened to Dave's show in years. I really haven't, except for a couple of times when I've listened to little snippets of it or listened to the podcast. But they say apparently he's giving less investing advice. Dave, thank you. Thank you for finally seeing the light. Let those of us who have a clue what we're talking about when it comes to investing, who've been doing it for 35 years, who've actually studied it, who actually understand how it works and that it's about diversification, it's about fees, it's about discipline. The same thing you preach for debt. And it's about avoiding salespeople because they add costs that are difficult to recover. That's the biggest problem with the salespeople. They add a layer of expenses that can take a long time to recover. Yes, registered investment advisors have expenses, and sometimes they're too high. You need to find somebody to whom you think the payment is worth the services provided. But the problem with so many of the salespeople, particularly annuity salespeople, but also stockbrokers, or as they call themselves now, financial advisors, is the opacity that they bring to their fee structures. It is not something that is discussed right up front, and it should be. That's my issue, is that a stockbroker needs to say right up front, this fund is going to cost you 5.75%. It's an A share. But over the long run, that 5.75% is going to be a whole lot less than the idiot down the street who's trying to sell you the same fund as a C share. Oh, wait. That idiot's me. Yeah, a lot of them, they'll say, oh, this is a no-load fund. Take a look at the expense ratio of the C shares versus the A shares, for example. If somebody's selling you an indexed annuity or a variable annuity claiming there's no commission, that's just a big fat lie. Even if they're selling you a fixed annuity, there's a sales commission associated with most of them. And somebody somewhere has to pay that in most cases. Yes, there are no-load annuities. Not many, but there are some. So my issue is transparency. And, it's funny, when we talk about our company, I will tell you right up front over and over and over again, our fee per year, 0.9% on the first $1 million. 0.9, then 0.5, then 0.3, I think. Is that right? Yeah, about that. So people should just tell you. Everybody gets paid, right? Your doctor gets paid. Your lawyer gets paid. They tell you well, not the doctors, but the lawyers tell you what it costs. Yes, that will be $500 an hour. Okay. Is it worth it? Pay it. Anyway, 855-935-TALK is our phone number. Just glad that Dave's giving less financial advice. Wanted to share that with you. Call me. Is it true? Is he giving, for those of you who listen, is he giving less investing advice? I hope so. Or I hope not. 855-935-TALK. We don't have any calls in the can, but we do have one that came in from talkingrealmoney.com. And this one is about bonds and annuities. In fact, the subject is bonds versus TIA traditional annuity. The question: thank you first, great podcast. I was considering investing 30% of my portfolio into Vanguard bonds as the fixed part of my investment, but after I looked at it in more detail, it's a little typo. After I looked in more detail at what TIA traditional offers, I'm now thinking of investing into TIA instead of bonds. TIA is the old teacher's annuity, individual annuity something association. It's a little different than what it used to be, but what he's talking about is a TIA fixed annuity. So he goes on. Here is my research about bonds versus TIA traditional. Most Vanguard bond funds average returns between 1.49 and 2.56. TIA crediting rate is about 4%. Vanguard money market is about 2.4%, still less than the TIA traditional. I think investing in bonds will be more risky than TIA traditional and less profitable. What do you think? Thanks. Less bonds. It depends on the kind of bonds you're getting into. Excuse me. Government bonds are more risky than TIA. Some corporate bonds may be more risky than TIA, but government bonds are less risky than TIA. Let me just read you a little bit from TIA's own disclosure stuff. Okay? The only rate you can count on, it's not the payout rate currently, it's the guaranteed rate. And the guaranteed rate you showed me on the annuity you were referring to was 3%. That's a decent guarantee. But you have to remember that what the insurance industry is able to call a guarantee is really not a guarantee. In fact, they even tell you. They say that in the footnotes. Quote, any guarantees under annuities issued by TIA are subject to TIA's claims paying ability. Claims paying ability is important. If they run out of money, you might not get paid for a very long period of time, and that has actually happened in the past. It is not like a bank investment. It is not like a government investment. As a matter of fact, they even state at the very, very bottom, this is the standard disclaimer, insurance and annuity products are not FDIC insured, are not bank guaranteed, are not deposits, are not insured by any federal government agency, are not a condition to any banking service or activity, and may lose value. Those disclaimers are not just there for no reason. They're there because that is a real possibility, and you have to take it into account. Higher returns are always, this is an absolute, higher returns are always accompanied by some negative, either lack of liquidity or higher risk. Insurance policies, by their very nature, if they're paying 4%, they're taking more risk than you would take in a government bond portfolio or even a government and corporate bond portfolio because they have to. Think about it. If they're paying you 4%, they have to make quite a bit more than 4%. At least 1% more and probably closer to 2% more. So that means they've got to go out into the marketplace with the same bonds and securities that are available to you and find a 6% return to make their profit, or a 5.5% return. That means internally they are taking risk that could come back and bite them, which it did Executive Life in California many years ago. It can happen. Not saying it will, but it can. So anytime, great. If you can get a higher rate and you understand the level of risk, I'm all for it. But if you're going to buy an annuity, please buy it from someone like TIA, where there isn't a surrender charge or a big commission being paid in most cases. There may be a commission, but not big. And again, if they're paying a commission, that money has to come from somewhere. And if you're making 4, where are they getting the commissions and their profits? Taking more risk. So it is not lower risk, but it does pay more. And that's going to be the case with almost anything. Always bear that in mind. And that's, please, this is one of the most important messages imparted on this program. Higher returns, no matter what someone tells you. Read the disclosures. The stuff they say in the disclosures is said for a reason, to warn you. If it says you may lose value, well, you may lose value. It seems pretty simple. Got a question about your investments? Either call me at 855-935-TALK, 855-935-8255, or send your question in through talkingrealmoney.com, talkingrealmoney.com. Appreciate you being there. Have a great weekend. If you want to call us live, we're here from 3 to 5 Saturday, 3 to 5 Eastern Time, noon to 2 Pacific, at that same number, 855-935-TALK, 855-935-8255. I'm Don McDonald. Thanks for being there.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.